What we're seeing is not a typical rally. It's what happens when confidence in paper exposure collides with rising demand for physical supply. It's what happens when a trading structure built to facilitate liquidity becomes an obstacle to delivery. And it's what happens when decades of expanding derivatives meet a finite physical base that cannot expand on demand. So here's the central question. What happens when claims on an asset significantly exceed the available asset itself, and that imbalance becomes visible to everyone at the same time? What happens when participants who were comfortable holding promises begin demanding the real thing? And what happens when the system built to absorb that demand discovers it can't? That process is unfolding now. As of Monday, February 9th, 2026, silver is trading in the low to mid $80 range per ounce. That price level alone has invalidated many long-standing assumptions. Trading models built around historical behavior are no longer functioning as expected. Risk frameworks that assumed capped upside are being revised in real time. Algorithms designed to fade rallies are being stopped out repeatedly. Forecasts calling for mean reversion have been abandoned. Instead, rising physical demand has collided with a derivatives market carrying heavy exposure. The speed of the move matters as much as the price level. Slow markets allow adjustment. Fast markets force decisions. When price gaps higher repeatedly and pullbacks become shallow, psychology shifts. The question stops being whether to participate and becomes whether access will still be available. For those positioned incorrectly, the focus turns to exit rather than strategy. This transition doesn't occur gradually. It happens in waves. When participants who accepted paper exposure suddenly require physical settlement, the change propagates through the system quickly. And that brings us to a development that adds complexity to the current moment. The Chicago Mercantile Exchange recently introduced a new 100-ounce silver futures contract at the same time physical availability was tightening. Officially, this is presented as increased accessibility, a smaller contract, lower capital requirements, broader participation. On the surface, that narrative makes sense, but timing matters. New instruments rarely appear during periods of stability. They tend to emerge when existing structures are under stress. A standard 5,000-ounce contract at current prices represents roughly $400,000 in exposure. A 100-ounce contract represents about $8,000. That opens participation to a much wider group. More participants can mean more liquidity, but liquidity can also function as an exit mechanism. When new pathways appear during periods of strain, it's reasonable to ask who benefits most. This rollout coincides with visible physical stress. Vault inventories are declining when they historically stabilize. Borrowing costs are rising when they typically remain subdued. Delivery timelines are stretching. Premiums are holding despite higher prices. Either the timing is coincidental or it reflects the need to relieve pressure within the system. The truth may lie between those explanations, but the questions themselves highlight how fragile the current balance has become. Under normal conditions, futures contracts rarely result in physical delivery. That's intentional. Futures markets exist for hedging and price discovery, not metal transport. Most positions are closed or rolled before expiration. The system works because participants assume metal would be available if required. That assumption underpins price credibility. If futures prices diverge from physical prices, arbitrage is supposed to close the gap. But arbitrage only functions when the underlying asset is accessible. When it isn't, the paper market can decouple from physical reality. That divergence is now becoming visible. Premiums are expanding. Delivery delays are increasing. Availability is tightening. The gap between quoted prices and actual acquisition is widening. Current data reflects a relationship between open interest and registered inventory approaching 4-to-1. In practical terms, that means multiple claims exist for every ounce designated for delivery. Under normal circumstances, that ratio isn't fatal. Most holders don't stand for delivery, but confidence changes behavior. Registered inventory represents metal specifically allocated for delivery. Eligible inventory is metal stored in approved vaults but owned by parties not obligated to release it. These are not interchangeable categories. As delivery requests increase, the system faces a choice: source additional metal or incentivize holders to release it. But no mechanism forces that release without price adjustment. This is where theory meets constraint. Geographic pricing adds another layer. Asian markets are quoting silver at substantial premiums relative to Western exchanges. That differential creates a powerful pull, drawing metal eastward. This isn't coordination or manipulation, it's simple economics. Buy where it's cheaper, sell where it's more expensive. What makes this cycle different is directionality. Regulatory and practical barriers mean silver entering certain regions is unlikely to return. Once metal moves east, it effectively exits the Western inventory system. This transforms what would normally be a balancing flow into a one-way drain. The result is a structural deficit. Consumption has exceeded new supply for multiple consecutive years, roughly 200 million ounces annually. With global mine production around 800 to 850 million ounces, that means inventories are filling the gap. Inventories are finite. When deficits persist, they stop being anomalies and become baseline conditions. Markets can ignore fundamentals while inventory buffers exist. When buffers shrink, price becomes the only remaining rationing mechanism. Industrial demand compounds the issue. Over half of silver consumption is industrial, and industrial use removes metal permanently. Solar panels, electronics, medical equipment, data centers. Silver isn't hoarded in these applications. It's dispersed, embedded, and effectively unrecoverable. The expansion of AI infrastructure, electrification, and energy transition has accelerated demand in ways that don't respond quickly to price signals. These are long-term projects with fixed specifications. They require material regardless of market volatility. Supply cannot respond symmetrically. Most silver production is a byproduct of other metals. Mining timelines span years. Recycling is inefficient. Policy cannot create ounces. This pressure manifests first in margins and borrowing costs. Elevated margins strain short positions. Rising lease rates signal scarcity. When borrowing metal becomes expensive, availability is limited. The difference between paper and physical becomes critical under stress. Claims can be created endlessly. Metal cannot. Ownership structures, custody terms, and redemption rights matter when confidence erodes. Delivery cycles approaching in March, May, and July will serve as stress tests. Watch lease rates. Watch premiums. Watch how quickly price declines are absorbed. And watch whether quoted prices continue to diverge from transaction reality. This is not a prediction. It's a framework. Silver is demonstrating a familiar pattern. When systems rely on confidence and confidence meets constraint, the constraint ultimately prevails. This isn't financial advice. It's an explanation of mechanics. Understand the instruments, understand custody, understand risk. If this helped clarify what's happening, support the channel and stay engaged. The coming weeks will provide more answers than opinions ever could.